In September 2024, China sold $53.3 billion in U.S. Treasury securities. This was the largest single-month reduction in history, but it wasn't the first time, and it won't be the last. In September 1931, Britain, then holder of the world's reserve currency, faced a remarkably similar crisis. Foreign creditors began dumping British government debt. The Bank of England raised interest rates to 6% to defend the pound. It failed. Within 72 hours, Britain abandoned the gold standard. Within 13 years, the British pound lost reserve currency status to the United States dollar. This video breaks down the four-stage reserve currency life cycle that has governed every global monetary system for the past 400 years. From the Dutch guilder in the 1600s to the British pound from 1918 to 1944 to the Bretton Woods dollar from 1944 to 1971. Using verifiable central bank data and historical records, we'll show you exactly where the US dollar is in this cycle and what the Stage 3 to Stage 4 transition has looked like in every previous reserve currency collapse. Every reserve currency in recorded history has followed the same four-stage life cycle. Stage 1. Adoption through strength. This is when a nation becomes the reserve currency through genuine economic dominance. They have the largest productive economy. They run trade surpluses, meaning they export more than they import. Their currency is backed by gold or other tangible assets. Other nations voluntarily hold this currency because it's the most reliable store of value and medium of exchange. This stage typically lasts 25 to 30 years. Stage 2. Dominance through debt. The reserve currency nation now maintains its status through military and political power rather than pure economic strength. Trade surpluses turn into trade deficits. They begin importing more than they export. Government debt grows, initially at manageable levels. This is often driven by military expenditures, Britain in World War I, America in Vietnam and the Cold War. Other nations continue using the currency, but now it's more about the lack of alternatives than genuine confidence. This stage typically lasts 25 to 35 years. Stage 3, crisis of confidence. Debt accumulation reaches critical levels. Foreign holders begin to question whether they'll be repaid in currency that maintains its value. They start reducing their exposure, selling the reserve currency, buying alternatives. The central bank must actively defend the currency, raising interest rates, selling gold reserves, making public statements of confidence. But these defensive measures often accelerate the crisis rather than resolve it. This stage typically lasts 10 to 20 years, but the final crisis, the break from Stage 3 to Stage 4, often happens very quickly, sometimes in days, sometimes in months, rarely longer than 2 to 3 years once the acceleration begins. Stage 4, replacement. A new system emerges. Sometimes it's a single new reserve currency. Sometimes it's a multipolar system with several currencies sharing reserve status. There's typically a transition period, chaotic or managed, lasting 5 to 15 years. The former reserve currency doesn't disappear. Britain still uses pounds. The dollar didn't vanish in 1971, but the dominance ends. The privilege of printing money that other nations must hold, that ends. These four stages are not a theory. They are not a prediction. They are an observed pattern, repeated across 4 centuries and 3 major reserve currency transitions. Now let's examine exactly how this played out in the most relevant historical example, the British pound from 1918 to 1944. In 1918, at the end of World War I, the British pound was the world's dominant reserve currency. 70% of international trade was settled in pounds sterling. Britain controlled the world's largest navy and the most extensive empire in human history. The pound was backed by gold at a fixed rate. 1 pound equaled 7.32 grams of pure gold. But World War I had been devastatingly expensive. Britain's war debt reached £7 billion, 130% of GDP. To finance the war, Britain had suspended the gold standard in 1914, allowing them to print money without gold backing. When the war ended, Britain faced a choice: return to the gold standard at the pre-war rate, or devalue the pound to match the amount of currency they'd printed. In 1925, Chancellor Winston Churchill made the decision Britain would return to gold at the old rate. This meant the pound was overvalued by approximately 10 to 15%. British exports became more expensive. Imports became cheaper. For the first time in decades, Britain began running trade deficits. Then came October 1929, the Wall Street crash. The The global financial system began to fracture. European banks, heavily interconnected through debt, started to fail. May 11, 1931. Credit Anstalt, Austria's largest bank, collapses. The panic spreads to Germany. July 13, 1931. Germany's Danet Bank fails. Germany declares a debt moratorium. They stop paying what they owe. Foreign creditors panic. If Germany isn't paying its debts, who else might default? They look at Britain. Britain had loaned heavily to Germany after World War I. If Germany couldn't pay, could Britain? In August and September 1931, foreign holders began converting their pound holdings to gold. September 15, 1931. In a single day, 200 million pounds in gold were demanded from the Bank of England. This was 22% of Britain's total gold reserves in one day. September 19, 1931. The Bank of England responds. They raise interest rates from 4.5% to 6%. The goal? Make it more attractive to hold pounds. Stop the gold outflow. It failed. Higher rates didn't restore confidence. They confirmed fear. If Britain had to raise rates this dramatically, the situation must be worse than anyone thought. September 21, 1931, just 48 hours after raising rates, Britain abandoned the gold standard. The pound was allowed to float. It immediately devalued by 25% against gold. From the acceleration of foreign selling to the abandonment of gold backing, 72 hours. But the formal end of the pound's reserve status took longer. From 1931 to 1939, Britain maintained what was called the sterling area, a trade bloc within the British Empire where the pound was still used. World War II from 1939 to 1945 completed the transition. Britain depended on American Lend-Lease aid. By 1945, Britain owed the United States more than it could ever repay. In July 1944, while the war was still ongoing, representatives from 44 nations met at Bretton Woods, New Hampshire. They designed a new international monetary system. The U.S. dollar, backed by gold at $35 per ounce, would become the world's reserve currency. From peak dominance in 1918 to formal replacement in 1944, 26 years. But the crisis, the moment when the system broke, took 72 hours in September 1931. Let's now examine the United States' first experience as a reserve currency nation, and why it had to reset the system in 1971. At the end of World War II, the United States held a unique position. The U.S. economy accounted for 50% of global GDP. America held 70% of the world's monetary gold. The Bretton Woods Agreement formalized what was already true. The dollar was the world's most stable currency. The system worked like this. The U.S. dollar would be backed by gold at $35 per ounce. Other currencies would be pegged to the dollar. If you held dollars, you could, in theory, convert them to gold at the U.S. Treasury. This was stage one, adoption through strength. But by the 1960s, the system was already under strain. The Vietnam War, from 1965 to 1973, cost the U.S. approximately $168 billion. President Johnson's Great Society programs, Medicare, Medicaid, urban development, added hundreds of billions more. The U.S. began running consistent trade deficits starting in 1968. More dollars were flowing out of the United States than were coming back in. Foreign nations noticed. In 1965, French President Charles de Gaulle gave a press conference. He announced that France would begin converting its dollar reserves to gold. He called the dollar's reserve status an exorbitant privilege. France converted $750 million to gold between 1965 and 1968. By 1968, foreign dollar holdings exceeded the value of U.S. gold reserves. Technically, the U.S. could no longer back every dollar with gold. In March 1968, the London gold pool collapsed. This was an agreement between central banks to keep gold at $35 per ounce by buying and selling as needed. It failed because demand for gold exceeded what central banks were willing to sell. The market split, $35 for official central bank transactions, but gold traded freely among private holders at rising prices. This was stage 3, the crisis of confidence. On Sunday, August 15, 1971, President Richard Nixon appeared on national television. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold. The gold window closed. The Bretton Woods system ended. But unlike Britain in 1931, the U.S. dollar didn't collapse. Why? Because 3 years later, in 1974, the United States made a deal with Saudi Arabia. Saudi Arabia would price its oil exclusively in US dollars. In exchange, the United States would provide military protection and sell weapons to Saudi Arabia. Since every nation needs oil, every nation would need dollars. The dollar transitioned from gold-backed to oil-backed. This wasn't stage 4, a collapse and replacement. This was a reset, the start of a new stage 1. We'll call this dollar 2.0, the petrodollar system. And the clock started again. The petrodollar system established in 1974 is now 50 years old. Let's map it to our 4-stage framework. Stage 1, adoption through strength, 1974 to 2000. Oil is priced in dollars. OPEC nations must accept dollars. This creates structural demand that didn't exist under Bretton Woods. The 1980s and 90s see U.S. economic dominance. The Soviet Union collapses. The internet boom. American productivity. By 2000, the dollar accounts for 71% of global currency reserves. This is peak petrodollar confidence. Stage 2, dominance through debt, 2000 to 2020. The wars in Afghanistan and Iraq cost approximately $8 trillion across 20 years. The 2008 financial crisis. The Federal Reserve's balance sheet explodes from $900 billion in 2008 to $4.5 trillion by 2015. Trade deficits become a permanent feature. The U.S. imports $800 billion more than it exports every year. China becomes the largest foreign holder of U.S. Treasuries, peaking at $1.316 trillion in 2013. U.S. national debt grows from 60% of GDP in 2000 to 108% of GDP by 2020. But the dollar remains dominant because there's no viable alternative. The euro is too young and too fractured. The yuan isn't freely convertible. Gold isn't practical for international trade at this scale. The world continues using dollars, not out of confidence, but out of necessity. Stage 3, crisis of confidence, 2020 to present. March 2020, the COVID-19 pandemic. The Federal Reserve prints $5 trillion in 18 months. The M2 money supply, a measure of dollars in circulation, increases by 40%, the largest peacetime monetary expansion in U.S. history. National debt, 108% of GDP in 2020, 123% by 2023, February 24th, 2022. Russia invades Ukraine. The United States and European nations respond by cutting Russia from the SWIFT payment system. Russia's central bank reserves, $630 billion, are frozen. This was unprecedented. A nation's reserves held in dollars and euros, made inaccessible by political decision. For every other nation watching, the message was clear. If you hold dollars, those dollars are conditional. They can be frozen, they can be seized, they are not truly yours. China noticed. From peak holdings of $1.316 trillion in 2013, China has reduced exposure every year. By September 2024, China holds $774 billion, a 41% reduction. September 2024 alone, China sells $53.3 billion in treasuries. This is the largest single-month reduction in history. August 2023, the BRICS summit in Johannesburg, South Africa. They discussed creating a gold-backed currency to settle trade between member nations. December 2023, Saudi Arabia allows China to purchase oil in yuan rather than dollars for the first time since the 1974 agreement. Central banks globally purchased 1,000 tons of gold in 2022, 1,037 tons in 2023. This is double the average annual gold purchases from 2010 to 2020. These are stage 3 indicators. Foreign holders reducing exposure, seeking alternatives, central banks buying hard assets. Let's now directly compare September 1931 Britain to September 2024 United States. Britain in 1931, debt to GDP at 130%. United States in 2024, debt to GDP at 123%. Britain in 1931, foreign creditors dumped £200 million suddenly. United States in 2024, foreign holders have reduced $534 billion over 12 months, gradually but accelerating. Britain in 1931, gold standard backing suspended under pressure. United States in 2024, no backing, pure fiat currency. Britain in 1931, US dollar emerging as alternative. United States in 2024. BRICS and yuan system developing as alternatives. Britain in 1931. Burdened by World War I debt. United States in 2024. Ukraine costs. Potential Taiwan conflict. Middle East involvement. Britain in 1931. Running trade deficits. United States in 2024. Running a $773 billion trade deficit in 2023. Britain in 1931. 2 to 3 years in stage 3 before collapse. United States in 2024. 4 to 5 years in stage 3 so far. The parallels are striking. Debt levels nearly identical. Both running persistent trade deficits. Both facing rising military costs. Both seeing foreign holders reduce exposure. But there are 4 critical differences that extend the timeline. 1. No immediate alternative. In 1931, the US dollar was ready. America had been building economic dominance for 30 years. In 2024, there is no single ready replacement. The yuan isn't fully convertible. The euro has its own structural problems. BRICS is a coalition, not a unified system. 2. Military dominance. Britain in 1931 was losing naval superiority. The US in 2024 still has the world's dominant military, though maintaining it is increasingly expensive. 3. Network effects. In 1931, the pound was only 40% of global reserves. The dollar today is 58% of reserves and 88% of foreign exchange transactions. That's enormous inertia. 4. Financial market depth. The U.S. Treasury market is $26 trillion, the deepest, most liquid bond market in history. There is simply no alternative of comparable size. These differences don't prevent stage 4. They extend stage 3. Britain's stage 3 lasted 2 to 3 years before the September 1931 break. The U.S. entered stage 3 in 2020. We are now in year 5. If we follow the pattern, accounting for the dollar's structural advantages, stage 3 could last another 3 to 5 years before the transition to stage 4 accelerates. That would place the critical transition period somewhere between 2025 and 2030. What would stage 4 look like for the dollar? Most likely, not a collapse, but a reset to multipolar currency system. The dollar remains important but shares reserve status with the yuan, the euro, possibly a BRICS gold-backed unit, and perhaps digital alternatives. Just as the British pound didn't disappear in 1944, it remains Britain's currency today. The dollar won't vanish, but the privilege ends. The privilege of printing money that other nations must hold to engage in trade. That ends. The United States would have to fund its spending through actual economic production rather than currency creation. Budget deficits would become unsustainable. The U.S. remains a powerful nation, just as Britain remained powerful after 1944. But the free ride ends. This is not speculation about dollar collapse. This is pattern recognition based on 400 years of reserve currency transitions. China's $53 billion single-month Treasury reduction in September 2024 mirrors the September 1931 foreign dumping of British government debt. Britain raised interest rates. They tried to defend the pound. The system broke within 72 hours. The United States dollar has structural advantages Britain lacked. No immediate alternative. Military dominance, deeper financial markets, network effects. This extends stage 3. But history shows it does not prevent stage 4. Based on the British pound, from crisis in 1931 to formal replacement in 1944, and the Bretton Woods dollar, from crisis in 1968 to Nixon closing the gold window in 1971, the stage 3 to stage 4 transition typically takes 3 to 15 years once foreign dumping accelerates. We entered stage 3 in 2020 with COVID money printing and the first signs of de-dollarization discussion. We are now in year 5. If the pattern holds, and it has held for 400 years, the acceleration phase is approaching. China's September 2024 Treasury dump may be the equivalent of September 1931 for Britain, the moment historians will later identify as the beginning of the final transition. Understanding this cycle is critical for anyone navigating the global financial system over the next 5 to 10 years. This is reserve currency history, where patterns from the past explain the pressures of the present. In the next video, we'll examine the second stage 3 indicator, why BRICS nations purchased over 2,000 tons of gold in 2 years, and what the 1968 London gold pool collapse teaches us about what happens next.